A market master is ready with us. Samir Arora is founder and fund manager of Helios Capital. He's joining us right now. Samir, good to have you with us here. Thank you very much for your time. We got a bit of a shakeout both in the US and not so much in India, but in the US. I mean, 10% of the NASDAQ is not small, but what's your sense? I mean, because you got a broader sense of things. Have US also making a bit of a trading bottom in your opinion? And what are the implications for the market here, in your opinion?
I think India is trying a bit too hard in trying to hold the market up in some sectors and in some areas. But for US, if you look at it on a year-to-date basis, the market is still very strong. So somewhere along the line in the last 8 months, something would have happened, whether it happened all in 1 month or over 2-3 months. So I'm not that worried. But, the US, I'm amazed that the US markets felt even till 2 months ago that the interest rates will be cut soon when the Federal Reserve again and again said higher for longer and stuff like that. So if we take US as sort of given for now for us, I think in India, some of these stocks, particularly in tech and in some of these small caps and some of these sectors, I think are a bit wild. And they will also have to give back, just like NASDAQ had to give back.
Samir, hi, good morning. Good speaking with you after a while. What
yes,
about what's happening?
You?
I'm well, thank you. But what about what's happening here in the Indian markets? It's very interesting because we are at lifetime highs. But now looks like the train is not moving forward. You think it's because of Brent crude prices, because of the upcoming general elections? I mean, what do you think is stalling this market now?
So first of all, I don't think the market actually has gone up a lot. If you look at it on a calendar basis, which means it is up, say, I think NSE 500 is up, I think 12% or something, which is more or less in line with our annualized returns over the past 5, 10, 15 years, which are, say, 14%, 13% per annum. If you also add last year's numbers, which were only up 4%, then in 20 months, you are up less than 1% a month. It's the mid-cap, small-cap, which have had this rally, and particularly from March. So they need to correct a little bit. I don't think the larger stocks are in any way signaling that they're all-time high. In fact, the banking sector is down. IT sector is up, but should be down, according to me. So in general, I would think there is some difference within different sectors, and some of them will correct and some of it may be justified. But overall, you can't be nervous about the market.
Hi, Samir. Good morning. Samir, you said it right. The party has been in the broader markets, the mid and the small cap space. But the biggest heavyweight hasn't performed. HDFC Bank. Has its time come now? Everything is looking like it's perfectly in place, but the stock is still not performing. What's your take on it?
We like it a lot and it will perform, but you have to position it correctly. So, we have these two categories of stocks. One is where we think that it will do a little bit better than the market, which we call high confidence in reasonable return. I think that you can take it as nearly guaranteed because one day the market will fall 3% and this stock will be up 2% and it would have outperformed the market. Point is, even last year when it looks that it didn't do anything, NSE 500 was up 4%. And HDFC Bank was up 11%. So we are not going to expect 30% returns from this stock, but a portfolio needs both kinds. Unless you are a small cap fund and want to be a 2-year wonder kind of a fund that, you do well for 2 years, raise a lot of money, then down 50%, like it happened in 2018. But for any diversified fund or any fund which wants to be consistent across periods, you can't only have the biggest bangers at the same time. You need a sort of a combo, and we position it as high confidence in reasonable return. And in reasonable return, which means beating the market by a small extent, we are very confident.
Samir, you've had a slightly negative view on autos for some time, right? With all the disruption, etc., which is happening.
Always.
Do you still think that will be the case, or the space not done badly, but the market's not done badly, so it's kind of come up with
Actually,
everything else.
That is the thing. The beauty of this market is, and all markets, is that many stocks do well. If you don't like something, just ignore it. Whether it works or not doesn't matter because it doesn't take away much from your opportunity set. We philosophically don't like it because we philosophically don't like betting on things that nobody knows about, and then betting on 1 month numbers when you don't know exactly the bigger picture of EV versus cars. And in general, in India also, if you see the cars which are, I saw a report from one broker that cars which are priced less than 7 lakhs, the numbers are, I think, at COVID type lows. It's only the top 10%, 15% of the Indian public and the top selling everything, cars and everything else, which are doing well. By the way, we own Landmark since IPO day, and it's up some 70-80%. So indirectly, directly, there are many ways to do it. But I don't believe in the overall car story because I don't believe that companies putting billions of dollars into EV are adding anything to the industry, because they're just having to switch from IC car to EV car without any economic gain to everybody except the wider climate and things like that, but not to the company that aggregate. And then somebody might win in that, but who knows today who will be that winner.
You mentioned that data point, right? So cheaper cars, there's no such thing as cheaper cars now, but valued under 7 lakh rupees.
Lower, yeah.
Lower price. They're doing poorly. And that is true across a range of other things.
Everything.
Now, but the point is, Samir, so that has got to show up in retail credit, etc. as well, right? I mean, yesterday RBI released retail credit numbers for the month of August. If you look at the retail credit growth is steady, some 18%, but the piece which is doing well is mortgage. Everything else is down, little bit. But the point is, not growing.
Actually, there is a bit of a slowdown in everything. And therefore, now you'll have to be more and more particular about things and companies that can stand it. And anybody doing single line lending or single line growth, you'll have to be more nervous for some time till we get comfortable again that all this is still in control. Yes, absolutely right.
But do you think this is just inflationary impact, or is there? Because, if you go back a few years, going into COVID also, there was a bit of a slowdown, if you remember. And then, of course, I mean, the next couple of years were, it kind of was all over the place, and we managed the situation well. But yeah, is it just inflation or more structural?
I think the way to look at it is that everything should be compared to pre-COVID and assume normalized growth from there, rather than in places where there was very rapid growth. In nearly every place, even in US, even in India, most of the rapid growth has become normalized, and normalized not that you can continue to grow, but the 5-year numbers, 4-year numbers will become as if there was no COVID, or maybe 1% here or there for some particularly sectors that were benefited. But in general, over this period, because of COVID, primarily I think that the loss of savings and the loss of income was so high that people have not recovered. And therefore, this disparity has increased. It's in all the stocks we look for, whether the middle class or the upper middle class or the rich class are the buyers, then we feel more comfortable right now.
The space to be in, at least that's what the stock performances are showing, is this entire power, renewable energy, capital goods space, right? And historically, if you map it in the run-up to general elections, when spending picks up as well, the capex cycle recovers. But do you think this is just cyclical in nature, or is this some sort of a structural up move that you're seeing? And are you partaking in it in any way?
Well, we have NTPC, but otherwise we don't have any of these things. But in general, the thing is that after COVID or pre-COVID, the government deficit used to be, I forget even now, but must have been 3-point-some% with a plan to go towards 3%, and then it went up to 9-odd%. And then slowly it's back to whatever 6%. But someday after elections, the government will have to announce the new fiscal path, and that path will naturally lead to some 0.5% per annum decline in fiscal deficit or some map like that. And therefore, I think that after elections and for next year, that is 24-25, the government spending cannot be as high as it is now. And, the base would be high. And also many of these projects, because of completing them in this 5-year cycle, would have been completed or near completed. So there is no way that the same thing can continue. And, this idea of cyclical versus this thing, for many of these infra type projects and investments, it is always cyclical because governments never have continuous money at all the times to be able to keep up with this pace. Even the tax increases there might be very high, but then on this base, can we imagine another 20% growth? It's very difficult to imagine.
Actually,
therefore, in some sense, they're cyclical.
No, let me try and maybe rephrase that question, right? Are we in that 2003 to 2007 phase? I remember at that time, the sort of these capital goods, stocks, power stocks, etc., had seen a 3-4 year upcycle. So do you think this is the start of that kind of an upcycle?
I don't think it is the start.
No,
because that, the returns there were 40% per annum for 4 years. And in theory, you could have turned bearish 1 year before and you would have been better off than playing it till the end. So if you think this is is it 2003? Oh my God, that is too much to dream. I think let's not go that way or that far. The equity market guys do not need such aggressive dreams or such aggressive returns. The idea is equity markets in general in India give 14%, 13% return per annum. These returns are in line with the earnings growth, in line with nominal GDP growth, in line with risk premium over fixed income. These returns are higher than what you normally make in fixed income, than the returns you make in gold, return that you make in property. And that is this game. If you make too much more, you will have to give up some of that. But the point is today, if you look at this calendar year or you look at last 20 months, particularly if you look at last 20 months in dollars, these returns are not, we haven't even got our normal annualized numbers. In addition, we have a marginal or a serious shift of some interest from China into India. Plus, we have domestic flows, which used to be not there, say, 5-6 years ago or before 17. So therefore, you have higher expectation, higher confidence that you can make the 13, 14, 15% index return. That is actually enough for somebody to allocate as much as they can. And if it goes much more, initially you take it with pleasure and then you get nervous later on.
Samir, the last couple of questions before we let you go. Share us some new ideas. I recall when you had bought some of these new age companies, I think Paytm, Zomato. Share something new that you have added to the portfolio.
So
and
now
you continue to hold these. Yeah.
We continue to hold, and very soon, one day, we'll have a mutual fund. So once you buy that, you will see new ideas in it. Why should we not able to tell it?
Is this a pitch, Samir?
Now it's a small
pitch.
entry cost. Small entry cost to see the new ideas. Sometime down in the next 1 month or 1.5 months, we'll be there.
I could be on board that one.
Thank you. Everybody listen to him.
Could be.
All right, Samir. Yeah, he's not committing.
I don't know if Samir is toying with you or you're toying with Samir, but anyway. Samir, but seriously, anything incremental, anything new you've kind of put your money behind recently? Nothing.
The team, nothing new that we bought in our current funds, basically the same. We just enjoyed not having IT because I was getting nervous. Now I am confident that I can pass the next 6 months very peacefully again. So it's all good.
All good. All right. Fair enough. We'll leave it there, Samir. Great speaking with you and appreciate you coming on board and sharing those insights with us. Well.